Both the Bank of International Settlements and the IMF have consistently warned against the dangers of emerging markets debt. China is responsible for the bulk of the increment, but it's not alone. Over the past decade, in emerging markets, lending to non-financial corporations has risen the most, while in advanced economies it fell over the same time. Nevertheless, investors are paying ever higher multiples for future company earnings in emerging markets. On the one side, macro worry, on the other, micro euphoria. So, who's right and where are we headed? Look at EM corporates closely and you'll find that firms in MSCI Emerging Markets Index, the benchmark global investors follow, have been deleveraging since 2014. But smaller companies trading on local bourses, well, that's a different story. The debt's also coming from unlisted companies borrowing cash from local financial systems, which in turn have borrowed abroad. The biggest issuers of debt in emerging markets have been financials, energy and utilities, sectors with firms that tend to be closely linked to the government. In the past, stocks in these government-linked companies have traded at a substantial valuation discount to fully private sector firms. But over time, energy, materials, telecoms and utilities have become less important, whereas tech, private financials and consumer discretionary sectors with little government ownership and low debt have become a larger part of the market. So, can government-linked companies keep adding to national debt while private companies in a parallel universe keep getting re-rated? No. It sounds too good to be true, and it is. In the near term, currencies will have to foot the macro bill. It is telling that even in a strong cycle such as one seen over the last 12 months, emerging market currencies struggled to appreciate in trade-weighted terms. For the foreseeable future, high debt levels in the economy are unlikely to compromise emerging market equity valuations. But over the long term, unless these government-linked companies delever aggressively, equities themselves may pay the price. And here's how. Rising liabilities will ultimately end up on government balance sheets. That credit risk can push up government bond yields, directly affecting the cost of equity, including of unlevered private sector companies, thus compromising the firm's return. It is worth emphasizing that this will be a slow process. Even on the present upward trajectory, it will take 3 to 5 years to hit critical levels of public debt. In the foreseeable future, emerging market equity investors will have to contend with weaker currencies and likely slower earnings growth, but not a debt-related derating of multiples. So, the macro-micro divide in emerging markets is likely to persist for now, but the clock is ticking.